most permanent policies today have what's called living benefits. And what that means is that if someone suffers a chronic illness or has a terminal illness, you could access part or full or a portion of your death benefit while you're living to maybe seek treatment somewhere else or to take your family on a last ditch vacation if you have a terminal illness. But these policies have these built into them. They can use them while you're living, the death benefits. So there's ways you can access the death benefits while you're living. So a traditional policy has its place. And I think that people overlook that because it's a great foundation for a financial plan.
All right. Hello, everyone. Welcome to the Twin Shores Financial Freedom Podcast. This is Timothy Nihill, CEO and founder of Twin Shores Financial. Today, we have a special guest on talking about a very, very interesting topic of insurance. So our friend and investment consultant, Mark Martin, is here to talk about really the ins and outs of the insurance business, talk about how Americans are the most underinsured group of people across the entire world, and how people are leaving a lot on the table from, I would say, an investment perspective, a tax management perspective, an estate planning perspective, and a strategy perspective by not taking advantage of the opportunities in the insurance world. Keep in mind that the insurance companies and insurance and the concept has been around for thousands of years, so it is time tested. And I can tell you there are tremendous opportunities when properly using insurance as part of your overall financial planning and wealth management strategy. So enjoy the content. It might not be the sexiest of all, but at the same time, there are a lot of opportunities that might be a fit for you, your family, your friends, your companies, and away we go.
I appreciate you guys having me on today, and hopefully I can give some great information to individuals. Personally, I started back in the business out of college in 1989, so I've been in the business for many years.
You're kind of like a rookie.
Yeah, kind of like a rookie. I started out my career with Metropolitan Life, and then slowly progressed on to getting an independent advisor as well. I kind of wear a couple different hats in my career at this point in time. I have my own financial practice. And I also am a wholesaler, as you had said, with National Brokerage Atlantic, where I help individual agents or advisors fit the insurance need with their current clients, whether that be life insurance, disability insurance, or long-term care insurance.
Awesome. So, Mark, you and I, we go back a few years, and obviously we've been in the business a few years. One of the things that we're always talking about is if you look at the statistics, Americans are the most underinsured population in the world. Why do you think that is?
I think it's mostly because if you ask, LIMRA's done studies on this, obviously going back for years, and LIMRA is an organization, for those of you who don't know, that is an advocate for the life insurance industry. But, there's a negative connotation towards insurance agents in general. But if you ask somebody about their personal agent, they love their personal agent, but they have a negative connotation towards life insurance in general. And I think it's just they're not fully educated on the different forms of life insurance that you can have, or disability or long-term care. And they do not want to talk about it because at parties, nobody talks about their life insurance. They talk about the stocks they own. It's not a fancy financial instrument to own.
Well, we know everyone in those parties and cocktail hours is completely full of crap. They're all lying about their portfolios, and they know it.
Exactly. Nobody wants to admit that they, hey, I got, this type of insurance, or, they're put this, you're paying that much for your life insurance. And that's where people kind of get misnomer life insurance, is that it can be used as an alternative asset class in today's marketplace. And I think that's where, if you're using permanent life insurance, I know there are some individual advisors out there or planners that do not necessarily believe in using life insurance in their practices, but I think that's a huge mistake in their practices.
Yeah. So let me ask you a question, Mark. What do you think is the biggest misconception people have with life insurance, or really any type of insurance, right? It could be disability, it could be medical, it could be long-term care. Obviously, everyone talks about Medicare, Medicaid, and the rising costs, of medical expenses in retirement. But I think what people are not seeing yet is actually taxes are going to be the number one expense, and then medical's number two.
Well, I tell you, you're going to bring up a good point with the tax situation, Tim. A lot of individuals, reason why I think that's an undersold marketplace is that life insurance agents are a dying breed, and the old time agents are not around anymore to go out and talk to individuals with the life insurance industry to bring up the topic of life insurance with their clients. A lot of advisors, like I said earlier, they want to be a sophisticated planner, and they tend to forget. I am a certified financial planner as well, and there's a whole section in the CFP course concerning life insurance and insurance itself. So it's a very important piece to everybody's background. I mean, financial picture. So I think they underinsure people because their advisors aren't talking to them about it. I think that's the main reason it's not there in the marketplace. The advisors not necessarily understanding insurance themselves.
Really? No kidding. Interesting. Now, would you say, in what you're seeing on the insurance side of things these days, is that changing at all? Right? Like I have my CFP as well. And we don't have any problem talking about insurance. It's like, in fact, something we talk about way before we even talk about the investment side of things. It's a dying breed, yes, but at the same time, is there any change there?
I don't, the changes in the industry are coming around. I mean, if you look at the industry in the whole, life insurance has come since I started. The industry is making tremendous leaps forward. For instance, on the cost of insurance with term insurance right now, the cost of insurance has gone down greatly over the last few years with this new CSO tables, and people are living longer. You got to remember, life insurance mortality charges are going down. People are living longer, so that makes a life insurance policy tend to be a little bit less expensive. And some people, if they can't afford to put up a whole lot of insurance into a permanent type of policy, term insurance is a heck of a way just to cover a need in the short-term amount. They're going to remember, think about the cost of a family, a young person just starting a young family that may have.
We may have one people on this, by the way.
Okay. So, well, this is important.
Alex, how old is your son?
6 months.
6 months? And Alex,
Yeah.
I'm going to put you on the spot. How much life insurance do you have?
0.
Why is that, Alex?
Because Tim isn't doing his job.
I think you'll find that we have some quotes for him in there.
So, okay, let's just look at this for example. You have one child, okay? And you have are you on your house?
No, we pay a mortgage.
Okay. What's that?
We pay a mortgage.
You pay a mortgage. So, I mean, no, you live in a house, you have a mortgage, right?
Yes, sir.
You standing mortgage. And I'm not going to get into financial situations, your personal financial situation. But let's look at this. Does your wife work outside the home?
No, we both work from home.
Both work from home. Okay. So if something happened to either one of you, who will be taking care of your child?
Probably my father or her parents or her aunt.
So is that you? That's a common answer that people give now. Do you think that's fair to your parents or their parents to give up their time in retirement or to watch your child?
No.
Okay. So now what you've got is a couple different needs here. You've got what's called cash needs at death and income needs. So what you want to solve for yourself is to do a simple financial analysis. And I'm going through this. Look at your mortgage, your outstanding balance of your mortgage. So let's just say your outstanding balance of your mortgage is $250,000. Okay.
Okay.
And you have any other debts that you may have, cars, credit cards, something like that. So let's just add let's just say you have outstanding debts on your automobiles of another $30,000. That brings us up to $280,000, correct?
Correct.
Okay. So now we go to look at what happens if you were to die. Well, we have a funeral cost that's involved. My brother-in-law is a funeral director, and I can't get over how much a funeral costs if you want to have one. Personally, I could like to be like the Game of Thrones, put me on the river and shoot the arrow and burn.
That's the one you want to do. That one looks awesome.
Yep. So, you look at that. So let's just say a funeral is going to cost you another $20,000. So now we're up to $300,000 in cash needs right now in debt. So what I mean by that, if you died tomorrow, your wife could write a check to the mortgage, pay off all the debt, and pay for your funeral. Okay, cash needs a debt. Also, you want your child to go to college. If you're going to be if you're gone, it's less income to be saving for college. So you might want to put some money away for college. Let's just say another $75,000 to $100,000 now to grow for future rounds. So you stick that in there. That's now we're up to let's just say $100,000 for argument's sake. Now you're up to $400,000. Now you have income needs. Yes, your family's going to get Social Security until if you understand how Social Security works, you do have survivor benefits. But I don't want to be at the beckoning call of the government to provide income for my family. So you add some income needs on her. She might need some supplemental income to help pay for a child care, something to that effect. That your parents may become her parents. You never know what happens. Disability, move away, whatever happens. So let's just say, for argument's sake, you need a $700,000, another $300,000 for income needs. I'm just making numbers up here, obviously. Now that your numbers start to grow, before you know, you're probably up to $1 million when you start really adding everything up. And when you get that, people get shell shocked. I need $1 million worth of coverage, and the first thing some people say, "Well, I don't want her to have all that money, or I don't want him to have all that money." Well, it's life insurance is bought out of love. Your family needs to be financially secure. So you can accomplish that need with a couple different areas. You can either buy, let's just say you have a limited budget, and most people have a limited budget. You're just starting out. My son's in this condition. He's going to have a baby in 4 weeks, and we got to get some life insurance on him. And I'm actually neglected by not getting more life insurance on my son at this point in time. So we need to go out and purchase a pretty nice policy for him and his wife, and we'll probably get most of that coverage within term insurance, using term insurance. Why? Because it's inexpensive and it can provide the need if something were to happen. Right. So we might go out and buy a 25 or a 20 or 30-year term for $1 million. And the cost of that being young is going to be relatively inexpensive. I mean, it's probably going to be less than $50 a month to do that. And if there's other coverages that need to be, they want to do some planning with permanent life insurance, we can always put that into place too, to build up cash values for later use of retirement, or if whatever you need, whatever you'd like to have those for. But my point is that being underinsured, this is how you calculate how much life insurance you do need in your life. And I think that's a simple example of what you would need. I hope I got you thinking, Alex.
Yeah, thank you. Yeah.
Are you kidding? His wife is going to watch this video. He's going to be buying it tomorrow.
The thing about it is, as I told you before, I'm Italian, so you worry about things like that.
Yeah.
And you buy a lot of life insurance, and all of a sudden your wife's looking at you, walking down the steps and pushes you down a step. Well, you know what? You can always make a trust a beneficiary where she doesn't get it. She just lets it come.
Right. And that's the thing, is you can institute with the trust work, you can institute controls beyond the grave, as they call it.
Exactly.
Like I do that, I have that with my kids and all that stuff too.
You bring up a great point with that, Tim, is that with other areas overlooked in this whole financial planning process is wills, young people with wills. If both you and your wife were killed in an accident, Alex, think about this. Now you've got a child out there. Who's going to take care of that child? Well, you don't want the child to be the beneficiary of that money, so you have to put into a trust that goes into a trust. And I've always recommended to my clients that the person who's going to be taking care of the children, that's going to be the custodian of your children, is not the person who gets the money. Yeah. You have somebody else control the money, but it's not fair to them to bring that child into their home and disrupt their home financially as well. So you have somebody else administrating the money to make sure that that's being taken care of and not being abused for the future of your children. And my family was always, I knew that you could count on. I had a friend at one time that was going to be the trustee and take care of that. As the kids have gotten older, my children are gone now, so we've changed things around. But that was just something we had. I didn't want the custodian of our children to be worried about financial, what they had to do with obligation. That's kind of unfair. And what's the word I'm looking for there? That them to have the access to the money and take care of the child. You don't know. I hope you can trust everybody, but in the real world, it's just
but you don't know anymore, right? Like if you look at the statistics, when you talk to people about legacy planning and generational planning, and they're like, "Oh, I'm just going to give it direct to to my kids. Well, yes, you can do that. But your kids on average, or whoever the beneficiaries are, they're spending that money within 3.5 years of getting it. That's the national average, right?
Yeah, it's I'm pretty sure that is. I mean, they go through it. I mean, think of people who've won the lottery. How many people have won the lottery and gone bankrupt? How many people have won a big lawsuit because they've been in the car accident? And next thing you know, they don't have any. They're not responsible.
There's just not that long-term thinking, right? It's just bad business.
You know, as an example, I have a friend that passed away from pancreatic cancer a couple years ago. He was 59 at the time of his death, and he had still young children in college. He still has them in college, and he left his family. He had 4 children. One was out of school, 3 were still in school, and his wife, he took care of him. He didn't use me as an advisor, which is fine. But I know right now her advisor is telling her she's spending too much money taking care, doing different things that she shouldn't be doing at this point in time. So even the surviving spouses, it's a heck of a financial responsibility for them. They think that money's going to last forever, and it may not last forever.
Right. And the biggest problem is I kind of equate it to people when they're trying to buy a house, right? Like, no one really looks at the true numbers of what the investment into the house is. They're trying to fit what they're buying into some monthly payment.
Correct.
And you just can't do that.
No.
And then the other thing I don't think a lot of people realize is, and I think this is one of the most criminal things that have happened in the past 5 years, is when Congress and they passed a law which removed the stretch IRAs and inherited beneficiaries for retirement accounts, right? So up until like 2 years ago, if you are a non-spouse beneficiary on an IRA, you could start life expectancy payments based on your life expectancy and take an annual payment every year, which was, let's say, maybe 5, 6, 7% of the account, depending on age.
Right.
And then you can have that money invested and you can essentially create your own income stream. Right? Now that option is completely gone. And then you think about for people that have overloaded their entire savings into retirement assets, is a massive generational baby boomer and even Gen X problem. When the money gets to where they want it to go, you have to pay 40% in taxes. And then the beneficiaries, Mark, right, that they inherit it, the beneficiaries, then their tax bracket goes up because they have to liquidate these things.
Well, you bring up a great point for estate planning purposes. You know, and this is an argument that goes on. You have some of the people the pundits that are out there talk about negatively about permanent life insurance. And permanent life insurance, I mean by universal life. There's different forms of universal life policies. There's whole life policies. We won't get into the different types of coverage at this point in time. But here's a prime example. You have somebody who has $1 million, and it's not hard. You're an investment guy, Tim. How many families you know that right now have $1 million plus in IRAs or 401ks at this point in time?
Right. It's growing.
It's growing. It's not hard to do. It's when they get their age. And I can remember when I first started in the business, you're trying to talk to people who are in their 50s and mid 50s, and you're a young guy trying to tell them how their retirement's going to be structured, and there's different steps. And they look like a deer in the headlights, like you don't know what you're talking about. And you talk to them about taxes, and they should be buying life insurance, permanent life insurance at this point in time in their life, because they're the most healthiest and youngest they're going to be. It's the least expensive it's going to cost them at this point in time. And they look at you and go, nah. And it's my job. I maybe young in the business. I didn't know how to do the full sales process at that point in time.
Right.
Now they get into their 70s and they still haven't. That money has grown exponentially in that IRA. And I tell them about the taxes and we talk about life insurance, and they can't get it because number one, they're not healthy, or it's really expensive. And they look at me and I go, remember when we had this conversation and you looked at me like I was a moron? And they go, yeah, I remember we did have that conversation. Because you look at let's just say the typical IRA with $1.5 million in it, rollover from a 401k, you're going to have a significant amount of tax liability with that. So you have take a typical person that has an IRA, maybe of $1 million, $1.5 million. Let's just say that people get that money and they want to take it all at one time. What's the net on that? It's gonna be nothing. I mean, you're probably gonna net. You're lucky you're gonna net 50% of that, maybe $500,000 to $600,000 of that money. Where's the rest of that go? Well, it goes to Uncle Sam.
And they're doing such a good job, right? Because Social Security money took care of bankrupt. The banking system just collapsed. I mean, keep giving them money. Why not?
That's it. Keep giving them money. They're just taking care of everybody's student loans. Anyway,
my mom as a CPA is rolling right now when she watches this. She's going to be like, "Oh my God, my child."
But let's just look at this scenario. And so if somebody buys that life insurance, okay, what are you saying here? Well, there's ways of doing planning that you can avoid zero tax on that IRA. So let's just say our individual is got $1 million in an IRA and making, again, I'm making up some numbers here, and they have some other assets along with that. And they really don't need that IRA to live off of. How many people that don't wait to take the IRA distributions as the required minimum distribution?
RMDs. And then even when a lot of people are getting to them right now, they're like, I don't want to take this.
I don't want to take. What am I going to do with this? Well, here's a strategy that they might want to leave. Think about this. They take the IRA that they currently have, which if they leave it to the family, it's going to be a huge tax burden. They can control the taxes at this point in time. They buy a life insurance policy for the amount of the IRA, which is completely tax-free to their beneficiaries. And when they die, they leave the money to a charity.
Right?
But you have the kids make their own charity?
No. I would like to be my own chair. I like to be my 503C, but I can't do that. But, and they, create a legacy. It's a charity. There's zero tax on it. The charity pays no tax. The kids are still whole with the life insurance. They still get that completely tax-free, and everybody's happy. Or buy enough life insurance to pay the taxes on that. So they still get $1 million net.
Right. The other thing that we used to talk about in the planning circle years ago was a concept which they would call like a super Roth, right? And it was like, okay, so you could fund a Roth IRA account. At the time it was $2,000 a year, right? Or you do Roth 401ks just came out and you could put 10,000 into it. But you still have to keep that money pretty much in the account and growing until you're 59 and a half. You're
able to access to it. Exactly.
You don't have access to it. And that's true liquidity, right? People don't understand liquidity. Locking money up and being able to sell it out of a stock and bond is not necessarily liquidity. But
I agree wholeheartedly with that comment because, what do you net after something? That's the whole thing in a nutshell. And you bring up a great point with with another use for permanent life insurance is overfunding it and having it grow tax deferred, and you could take it out on a tax favored basis. What I mean about that is people don't realize that you could take cash values out of life insurance policies by using loans. And if you take a loan against the cash value life insurance policy, your loan rates are pretty reasonable when you're using life insurance as well. You can have, I don't want to get too complicated with it, but there's very, very favorable loan rates. You're basically just borrowing your own money. And there's ways of doing that you can get that income stream that is tax favored. But I mean, you're not paying any taxes because you're paying loans. You're taking loans instead of taking withdrawals on your life insurance policy. But also, you can use that to just take it out. And then what they have on there now is they have protection. Back in the day when I started, we didn't have this rider. It's called a Liberal Loan Protection Rider that basically says that if the person dies and there's a loan outstanding and their death benefit is always going to be more than than what the loan's going to be, so that loan is wiped out completely in debt. For an example, let's just say somebody has $100,000 in a life insurance policy and the death benefit is worth $150,000, and they're not paying the interest. And the loan continues to grow, and they die, and the death benefit's still $150,000. Well, that loan may be $140,000 because they didn't pay it off. They didn't pay it off back to the company. Well, what happens is the family still nets $10,000 to the death benefit because the death benefit goes to pay the loan off. Then the family does get that money. There's ways of doing that and using life insurance to a full leveraging type of situation.
Yeah, that's awesome. Mark, what are you seeing? So another podcast that we have, we brought on a friend of ours to talk about senior housing, independent care, assisted living, all that stuff. I remember when I got into business, right? At first, I worked for a bank and trust company that State Street bought out. They were called Investors Bank and Trust. IBT, we personally, inside those walls, called it IBT, I've been tricked. If you ever see the movie Office Space, we literally were a bunch of 20-year-old, 22-year-olds living the office space life. I mean, it was mind-numbing cubicle work. So then before I kind of made a couple of changes there, I found my way for a few weeks to try out. John Hancock was like the Cadillac of long-term care, right?
Mm-hmm.
And at that time, the sales process was, I had the same list that the other 50 guys called already in the previous 50 weeks. But it was pretty much call until you get an appointment. And then, you know what? You're a good looking American boy, so go sell something. Right?
Yep. The old days of the insurance industry. Yes.
I think most young people, if they saw some of the crap we had to do, they would. Guys did this.
They couldn't handle it. I'm sorry. To put it mildly.
We're chiseled veterans because of that. But one of the things we notice on our side, man, people are just not prepared for long-term care and medical and retirement. Talk a little bit about the changes we're seeing in the industry and a lot of the products that are kind of trying to fix this problem.
Again, long-term care insurance is what you're referring to. And that's a very overlooked area for advisors. And then anybody that has, a fiduciary responsibility to their clients should bring it up, at least talk about it, and let the client make a decision whether they need it or not. If they will, more likely they need it, but whether they're going to purchase it or not. And the days of the old traditional long-term care plans there's not too many companies out there selling the old traditional long-term care. What I mean by that is, you pay a premium and it's no cash value built up and there's nothing there. And just if you go into need the policy, it starts to pay you the benefit. There's some of them do have to return a premium at death at this point in time. But what happens with those policies, Tim, is that the insurance company reserves the right to increase the cost of the coverage on an annual basis. They can review it and increase the cost. And I'm sure, being as long as you've been in the industry, you probably have saw that. That's why there's a lot of companies, they didn't price the product right. There's a lot of companies not involved in this market space anymore because they had to get out of it.
Right. I mean, John Hancock had the Cadillac. I mean, it literally was the Cadillac policy. It covered everything. And they shut that down. What was it, about 8-10 years ago now?
Yeah. Well, CNA used to be in the marketplace. MetLife had one. I mean, you go back, all the big players had long-term care coverage. Now, none of them have. I mean, I shouldn't say none of them, but you maybe a handful. And I say, and that's 5. If you're lucky to find out the traditional policies. Speaking from my own experience, I had a client that I sold her a CNA policy to, and they increased the premium on her, and she called me, complained, called me back. The next year, they increased it again. And she decided she had a choice of reducing her coverage and keep the premium the same or paying the increased premium. Well, fortunately, she had the reserves to pay the increase of premium. It really wasn't that much. It went up a couple $100 a year. And she ended up going on claim. Well, I'm surprised CNA didn't put a hit out on her because her policy, she paid $30,000 in premiums and she collected close to $450,000 in that policy over her lifetime, her remaining lifetime. So you could see what a bad investment it was for the insurance company there. She paid 30, they gave her 450. So that's why traditional policies aren't around anymore. So as much as they were. But to answer your question, getting back to it with long-term care coverage, it's neglected. In today's marketplace, there are policies out there that allow an individual to either put a lump sum of money in or payment plan, and they can get their money back in one of three ways. There's some that have a complete return of premium. If they want to quit the policy, they can get their money back. If they go on claim, they're going to get their money back through the claim. And if they die without using the policy, there's a death benefit with it that they can get the money back through the death benefit. Their beneficiaries can get the money back. So to me, somebody who's got money sitting in cash that doesn't protect themselves in a long-term care situation and just has that money sitting in cash, that's a great alternative for them to use it, because they can take care of a need and not have any risk is what they're about, worrying about their money be able to get their money back on that policy.
Right. Which from a planning perspective and a strategy perspective, I mean, that gives you a lot of options.
It does. It gives you a tremendous amount of, and also those policies do come with inflation riders as well. And they're called hybrid long-term care. They kind of take the combination of life insurance, long-term care insurance, and combine them so that they make it more attractive. Now, they're not the days of having a lifetime benefit have gone away. There's only one company out there right now that'll pay you a benefit over your lifetime if you live long enough to exceed. Let me say this: if most companies will go out only paying you for 7 years on a long-term care policy at this point in time. They limited their exposure by not having because take a situation where someone is in great health and they have Alzheimer's. They could live for 10, 15 years.
Mm-hmm.
And that's where the insurance company kind of underpriced their product, because people were living longer and medical care was keeping them alive, but their mind was completely gone. And
well, this dementia disease is a big problem, right? Like, if you're up here in New England, for full-time care for someone with dementia, you're looking at anywhere from 10 to 17 to maybe even $20,000 a month, right?
It's crazy the cost.
It's the crazy cost. And then if you're a family member, like I know if I'm looking at my grandparents or my mother and father, I'm like, man, I don't want them going to a government-run facility, because they might
definitely not a government-run facility.
Right. So, long-term care it might not cover the whole thing, but if it puts a good dent in the savings and it helps you save.
You bring up a good point. Most people if you threw that number out at a client, they're going to get very shocked. They're going to be a sticker shock. Well, okay, we can't cover it all, but let's cover some of it. Right. Let's get you some money to take care of it. If we can't cover the full $10 or $12,000, let's get you something so that we can get you part of the coverage to be able to take care of it for you. And that's better part of the pie than none of the pie.
Right. And then let me ask you this question, because now we're seeing companies like Lincoln, for example, is coming out with a new variable annuity with a long-term care rider. Right?
Yes.
So to me, it looks like it's like, we're not against annuities, right? And people don't understand, like, first of all, there are annuities out there that have no surrender charges. They're fee-based annuities. They have great investment offerings. You could buy your riders and protections if you want, and they cost you $25 a month. Like, the old days of high commission annuity sales are pretty much over with for the most part.
And compliance really looks at annuities at this point in time. Regulators are looking at annuity sales.
Right. I mean, people don't understand, I think, the amount of process that goes in behind these things, and disclaimers and disclosures and data gathering. Like, it's a different ballgame now. Well, we look at these new VAs with LTC, it's like, well, I might have an investment account, and then, so I can grow my money. And then if I need it for LTC, I have it, or if I don't.
Well, yeah, exactly. You got the money. I mean, it goes to your beneficiaries. You're not locking and tying your money up. I mean, you're locking it up, but you're not losing the principal to the insurance company. You have that option at some point in time to use that money either for long-term care or it goes to your beneficiaries. So it, it gives you some options in your retirement years. You bring up a good point about annuities in general. You know, the one thing, whether it's a fixed indexed annuity, variable annuity, a regular traditional annuity, is that annuities to me, what I think they do to my clients, what they do for my clients is they get them the peace of mind at sleep at night, no matter what the market is doing, like it is doing right now. They know they've got these annuities, you buy those guarantees, but they give you some type of guarantee inside that contract. And they give you a peace of mind. And it could be an income stream, it could be death benefits, it could be a number of different things, as you brought up, Tim. And they provide security. You're transferring the risk from yourself to the insurance company.
Right. So
Now, there's a cost for that, but you know what? Some people don't care about that. They want that safety. They want to know that they're going to have X. They don't care what Y does.
right, makes sense. So Mark, share with the audience a little bit, maybe. I mean, protection is a big thing, right? So we already see what's happening in the banking world, and everyone's waking up to what FDIC insurance is or really is not. In the investment world, we have something called SIPC, which at the very least guarantees and secures at least $500,000 per account per person. So it's double FDIC. Talk a little bit about how the insurance world is a little different from a protection standpoint, and why insurance companies are, how they're supposed to handle client funds, what's protected, what's not.
Well, you bring up the state insurance commissioners as far, the state guaranteed insurance funds. And each state is different. And that's the bottom line. Everybody has to look at their own state. I know I'm in Pennsylvania, and as far as I'm concerned, we have one of the worst state insurance funds there is, guaranteed funds, unfortunately. But, everybody needs to look at that situation within their own state, to be honest with you there. And insurance companies are supposed to take their money, and the majority of their money is supposed to be invested in securities that are, not even say securities, bonds, real quality bonds, whether it be government bonds or corporate bonds, and real estate, hard assets, to make sure that that money is going to be there. A more safe type of traditional asset class than just going out and throwing the money in the market and watching it grow and crossing your fingers and see what happens. Insurance companies basically have to follow certain rules and regulations with their investments, and that's what. And most of them, I'd say, now there are some companies out there that have gone by the wayside, but for the general part, insurance companies are very financially strong.
I mean, they've only been around since medieval times.
Yeah, they've been around for a long time. And you look at I'm going to bring up a name. I don't like to bring up names, but you look at their Prudential, their assets. You look at Northwestern Mutual. I mean, they're not an independent company, but Lincoln, you brought them up. They're so strong financial. John Hancock. There's some companies out there that's what you look at when you're looking at an insurance company. Look at the ratings of the company, look at the Comdex, and they'll tell you where they're at, as far as their financials are concerned.
Right. So, Mark, let me ask you one more question. I mean, are there typical guidelines for people from an age perspective at what types of insurance they should be looking at? 20s, 30s, 40s, 50s, all the way up.
I think everybody should have some type of permanent insurance in their portfolio. It's like, I really do. Whatever that amount is. When you're younger, you can afford higher amounts because it's a lower cost for you. And I think that's a strong foundation. Think about building a house. It's just part of your strong financial base, and you have that, and it stays with you for your entire life. And that policy, and today's policies aren't. You bring up a point before about this is not your old time insurance. A lot of traditional, most permanent policies today have what's called living benefits. And what that means is that if someone suffers a chronic illness or has a terminal illness, you could access part or portion of your death benefit while you're living to maybe seek treatment somewhere else or to take your family on a last ditch vacation if you have a terminal illness. But these policies have these built into them. They can use them while you're living, the death benefits. So there's ways you can access the death benefits while you're living. So a traditional policy has its place. And I think that people overlook that because it's a great foundation for a financial plan. And then, obviously term insurance when you're younger is going to be least expensive. You could buy a huge amount while your family's growing with term insurance.
Alex is about to find that out next week.
Pardon?
Alex is about to find that out next
Yeah,
week.
he's about to find that out and go get some quotes. But, you look at when you get to be 55 and 60, generally, you don't need the life insurance for income needs for a spouse. You usually have established yourself. You've had that grow. What you need that, so you wouldn't want to look at term insurance more. To me, you want to look at more permanent coverage, whether it would be a individual policy or survivorship policy. A survivorship policy basically is what's called a second to die policy. Families will take that out to use for estate planning and legacy planning, where the cost of a survivorship policy is generally less than a regular individual policy because you're insuring two people, and the benefit is paid at the second death. I have my own personal example where I've used that with relatives, and I am the favorite cousin of two of my cousins because their parents they did legacy planning, and they both inherited a nice chunk of change, and because of the legacy planning that their parents did. We took IRAs that they weren't going to use for the 401k. They had other established investments. We shifted that money into life insurance. It leveraged the estate tremendously. And at the time of my aunt and uncle's death, my cousins received a pretty nice chunk of change and used trust to protect it. And I think people overlook the value of a trust. And this is my own personal experience with it. I have my one cousin, he has some mental issues, and he ended up getting into some financial trouble and some legal troubles. Well, guess what? Is that trust accessible, Tim, to the?
No, sir, it is not.
It's ironclad.
It's ironclad.
So they protected the assets in that trust. It protected the assets of their assets by using that trust. And my cousin, he could have been sued for, he had a DUI, and if he would have been in an accident and killed the family, they could have never got to that money. They're protected.
Now, Mark, are there opportunities to use insurance for situations that, if you're dealing with children that have substance abuse problems, addictions, things like that?
Well, yes, most definitely. Or you have children that have special needs children in situations.
Special needs.
Right. You have special needs children across the, somebody might have, autism or other special needs that are out there that they need to be taken care of. In that situation, trust, using life insurance to fund that trust, to take and have that trust hold the assets and provide income for that individual is a great planning tool, tremendous planning tool. Because if someone has substance abuse, the last thing you want, has substance abuse issues, the last thing you want them to do is have a large sum of money where they can go blow it and do what they want with it. It's going to create a huge problem. Just look at some of the rich and famous in our country at this point in time. I think you could go back and look at some people, and I don't want to use any examples, but you go back and look. There's some families out there that had some serious issues.
Right.
And there's some families that have raised their kids right and made them work, and you see the differences in the people. I'm going to get into political politics. I don't get into politics right now, but you can see a couple of examples.
Yeah, we don't do politics here.
No.
Maybe we won't. No. So, Mark, if you were kind of going to give people something to think about to summarize everything, what would it be?
Wow. It would be simply go back and look at your current situation and summarize whether you think you're going to have some type of need for coverage. And what I mean by that is just say you're a person who's 55, 60 years old and your house is paid off. You still have homeowners.
Yes, you do.
Why?
Right.
Yeah. Okay, I see what you're saying.
Because your chance of having a fire is less than 10% or a loss on your home is, I can't remember the exact numbers, but your chance of needing a long-term care situation is greater if your husband and wife is at 50%. One of you are going to need some type of care. And what's your odds that you're going to die? They're 100%. There's nobody to live
True.
So I think to just go back and reevaluate your current situation and really take a serious look at all your insurances across the board.
Yeah.
I don't know if that's the answer you're looking for, but that's what I'm thinking of right there.
Yeah. No, I mean that's smart, right? Because we talk about it all the time. Everyone thinks their home is their number one asset when it's really their number one liability.
Yeah, it's people it's amazing. They don't look at it that way. But you have clients come in and you talk to them about their house being paid off. You still have homeowners. Yeah. Why do you have homeowners then? Well, bank makes you have it whenever you have the loan. We all know that. I still carry a little bit of a mortgage, so I still, I'm required to have that by the bank. Well, after the mortgage is paid off, why do I carry it? Well, that's kind of, get yourself start thinking about things.
Right. Well, and it's tough now in the real estate market too, outside of what's happening with rates and all that stuff. But I know up here, like we're looking for build, buy, I have no idea. But it's like, I look at what they want for $1 million and like, there's no way in hell I'm giving you $1 million for this.
Well, property's gone through the roof values. I mean, just in my neighborhood alone, what the value of homes have gone up to, old homes it's incredible how inflation has caused a lot of things to go up over the last couple of years. And I think inflation is one of the greatest erosions of the states in our economy at this point in time. I think it's the biggest risk on the table.
Yeah, I would.
I mean, you look at the banking industry and with the things that are going on in the banking industry, and inflation is part of the cause of that.
Well, and the other thing too, you look at the younger generations now, right? You have the tail end of the Gen X, you have the Gen Zers and the millennials. I mean, they're just getting hammered on this stuff out there. And it was one thing when you lived in Boston in the 70s and you could buy a little, box of a home for $150,000 and then it turns into a $1.5 million house. Yeah, your lifestyle's awesome and it's great for you, but that's not going to happen anymore.
No, we're for it's going to be interesting in the economy in the years to come. It really is. I can remember as a kid growing up in the 70s, we had inflation. There was banks paying 10% on CDs. In fact, I don't know if I still have it. It was something in my mother's. I think I threw it away. But there was she's had a copy of a certificate that I still had. It was 10.1%.
Holy cow. I still remember my first bank account. I went to the bank with my mom. I opened up a savings account at M&T and I put in my $20, that I saved up taking bottles back to the corner store at 5 cents a pop. And I probably had 25 and spent the other 5 on 5-cent box. Bazooka Joe for a penny, and he had like cherry clams for 5 cents and Boston baked beans, which I found out were really funny with people and friends that have peanut allergies. There's a story for another day, but
yes.
But yeah, I mean, they were paying 20% on a savings account, and those days are long gone.
They've gone, and yeah, they're paying 20%, but inflation was what? So your net return on your money after inflation was probably negative,
right,
or close to it.
Yep.
And that's what we try to help people with, Mark, is talking about, and this is why insurance is on the table with this stuff. It's like, real diversification isn't I have 5 different mutual funds, a couple of bonds and cash. It's like you need insurance, you need long-term care, you need investments, you need assets, you need commodities. Like, kind of wake up.
It's a very diverse planning situation. People become more sophisticated in what they're wanting, and it's not the old days of just rock and roll, let it go. You got to get all asset classes, and I think that you just covered it right there with all your asset classes. Life insurance is a tremendous alternative asset class. It's going to provide you things that other asset classes are not going to provide, and it's going to provide at times that when the market is all crazy and going down, it's going to be there, and your cash value is going to be there in that policy, depending on the type of contract you have.
And the contract can't change?
And what contract are we talking about?
Life insurance or long-term care?
Well, it
We're
depends.
saying
They
the
can
premium
change.
can be raised, right? But
The rates on a long-term care policy, the rates can be raised. Okay, the coverage can be increased. There's a couple other things on it, but the one thing that you have to remember is the death benefit or the amount that you're going to be paid out is a unilateral contract. As long as you pay that premium and that's required, you will get that benefit.
Awesome.
Term insurance is a different animal. It's very simple, very, very basic. As you get into different coverages, types of coverages, things get a little bit more complicated, but it's always important to go through that with your client and explain it to them and walk them through the situation.
I think COVID have an effect in y'all's business and policy in long-term care or anything like that? When COVID hit, did you guys have any problems with long-term care?
Yeah,
or did it affect your?
It had a huge effect on it because insurance companies kind of shut down for 6 months to 8 months and underwriting because they were afraid. They were so afraid of COVID that they didn't know what was going to have the impact on mortality or morbidity. And they kind of, if you contracted COVID, you had to wait to show that you were fully recovered, and they still were kind of putting the brakes on high amounts of coverage. They weren't issuing the policies like they were in the past.
Right.
COVID screwed up this country so much, it's ridiculous.
Yeah. There's a lot of lagging effects that.
It's like the wave. The snowball just started here, and then all of a sudden it's out to here. Yeah. The effects on the economy, the effects on people, it's just unbelievable.
Kind of feel like it changed some things too, because I think a lot of people out there woke up too, and they're like, I don't know why I'm working the way I'm working anymore.
Well, exactly. Yeah.
And that's a big one. and my wife always has a saying. She says, you can never go backwards in life. Right. And it's like, once you open Pandora's box with that one, man, and people found out there are other ways to live their life and work and all that jazz, you're not going back to the old structure.
Nope, they're not. I agree with you there. It's a new paradigm in this country, and I'm old school, so it's hard for me to change. I hate change, but I'm going to have to change. I'll be 58 in May, and I'm beginning to be more like my father and my grandfather than I think.
Yeah, all of a sudden you wake up one day and you're like, you see the similarities. You're like, son of a.
Well, it's funny. My son, he looked at me and he says, you know what? You're right about this. You're right about that. He said, I told him, I said, Nicholas, it's nice that you said that because when I was your age, your grandfather started getting a lot more smarter too.
Yeah.
With age comes a little bit of experience. You need to listen to the older people once in a while. They know what they're talking about.
Yeah, for sure.
It's the reason why I got this gray hair.
Mine's getting worked in right now. So you guys, the other guys, you still got years.
I got time.
Plenty of time.
There you go. Just what you're going to look like.
No, it'll probably be gone before it turns gray. So,
well, that's at least I got it. That's what I said. I haven't.
This is going to be one of those that sits out there that people will watch. I mean, obviously, insurance is never the sexiest topic, especially when you have shit like crypto and Bitcoin and things collapsing. But it's fundamental.
Well, exactly. I mean, it's there.
Well, I have a question. If the banks do crash, hypothetically, how does my insurance policy, is it affected in any way? Like,
You have to remember, in MetLife in the 1930s, 1920s, with the Great Depression, they bailed out family farms. The insurance companies stayed. There was banks went under, insurance companies did not.
Banks and financial institutions.
I forget the statistic that Met used to give us all the time and about all that and about their assets, that they have under management, but they're a little bit different invested than what the banks are. What screwed the banks up, and I have a friend that retired, all he did was bank auditing, and I actually spoke to him today. And his biggest thing was that, what happened with Silicon Valley is, they were invested in treasury bonds, but inflation, they had to run on, they liquidated the treasury bonds. What happens is when interest rates go up, they're not worth what they paid for, and boom.
Yep. Paid a premium too.
The top banks have about $52 billion in unrealized losses as of 6 days ago, and now there's a new $620 billion hole that got created from yesterday's rate hike. Your bank is safe, forget it.
And the thing about it is, what he told, I didn't realize what he told me is, in the history of the United States, in a bank failure, there has never been any depositor that ever got their money. He said they've been made whole, but it's taken time, but they got their money. Even though FDIC and the government's always stepped in, but in insurance companies, what traditionally happens is the insurance company goes in trouble. The big boys come in and buy up the assets, and because they don't want federal regulation involved. They take care of one another, and they'll want the feds involved.
These insurance guys have been around a long time.
They have been. I mean, they got. You look at your big companies, and they're solid. A lot of them. I mean, they're more solid than what banks are.
Alex Kaminer, the MetLife building is still there, right? They still have the building in New York.
MetLife's still there, but it's just they've gone a different route. And I know what happened to them. I was here part of the downfall when I was with MetLife. They deserve to get blasted. Prudential, there's a reason why they're called the Rock. They are rock solid. Yeah, they're strong. And your Minnesota Life, I forgot to mention them. They're quiet. I mean, they're a good company. Securian, another good, well-managed company. Lincoln, I think Lincoln's always innovative with products coming out. Pacific Life.
Yep.
Pac Life. There's a piece. No, we're not. They were, going, but there's a piece out there for Pac Life that they've always made a policy enhancements and betterments on their policy when the economy's been bad. They make better product. They do better things for the clientele, their clients, the policyholders when the times are bad than they have than when the times are good.
Yeah, if you find that piece, can you send it?
I can get that for you. Pac Life is another good company.
Yeah,
I mean, I love them.
I have their whale upstairs.
I got this yesterday in the mail. I'm a part of their advisory council.
Oh, there you go. Congratulations.
I got that. I did something. And here's my well too. I have the well.
Oh, there it is. It's a beautiful paper.
Because I've done some a fair amount of life insurance. That was actually for variable annuities, the advisor council, right?
Well, I think the insurance companies have shown, man, there's nothing wrong with being conservative and knowing when to take your shots. They don't hit home runs. Yep.
They don't want to hit home runs. They like singles. They like doubles.
Right. By the way, I did find out in Jackson on one of their products, there's an investment where they have 3% allocated to Bitcoin and Ethereum.
Do they really? Which one is that?
It's Neuberger Commodity Fund. Yeah.
Smart.
No, what was smarter is I bought it for our clients 4 months ago.
Good man.
I didn't know about the BTC Ethereum deal. I was just because Nancy and I were doing, going through a bunch of investments across different products that they have on the annuity side. And we got the portfolio manager on there and he was going through it. And I went, really?
So it's, they had a commodities fund in there too at one time too. I wonder how that's at this point in time.
Yeah, whatever that other commodities fund was, they dumped it. So
What is Bitcoin at today?
28.25.
So how about this one? There's a young guy. I go to this restaurant every when my office, before I moved offices last April, I lived there according to my wife. It was a little bar down the street, like a Cheers. I loved it. You go in there after work, have a couple of drinks, go there for lunch, afternoon, have a few more, enjoy yourself, come home. There was a guy there. Mike is how old? Got to be in his 30s. Well, every day he's pulling out his phone and he's showing me his Bitcoin. His Bitcoin at the height was up to 11 million. I said, sell. Oh, no. I said, it's at 70, bring it 8. He goes, it's going to 100. I go, a bird in the hand is worth 2 in the bush. At least get rid of half of it.
right, you got to cash in some gains on the ride.
You got to. I mean, he would show his account.
But that's tax burden. Then he's got to pay tax on it. And he's just going to wait.
He had it overseas, and he was not going to pay the taxes. He was going to skate it.
Huh.
And God bless him, but if he got caught, he's going to be in serious trouble. But he was going to skate it. Just think about it. If he just sold that, went back in and bought it, back at the, somewhere near the bottom.
Right.
Yeah.
You sell it at 69, you buy it back at 20.
Pigs get fat, hogs get slaughtered.
And sheep get fleeced. Don't forget that last one.
What's that?
And sheep get fleeced. It's kind of like everyone talks about, like they have everyone, with these sayings. Sometimes it's like we've gotten so ADD on everything, right? Like, what is it? Curiosity killed the cat,
Right.
but satisfaction brought the cat back.
That.
On behalf of Twin Shores Financial, thank you all for tuning in. If you enjoyed this podcast episode and want to continue learning and how you can become a financially free individual, please tune in next week for another episode. Don't forget to like, share, and follow us on all our social media platforms. If you're listening on one of the various podcasting platforms, don't forget to follow us there. And if you're watching us on YouTube, please subscribe. Tim, anyone else? Any last words?
Yeah, and if you wanted to have more conversations, find us at twinshoresfinancial.com.
Phenomenal.
Thank you guys for having me. Appreciate it.
Awesome. Thanks, Mark. Appreciate it, man. Good to see you.
You too.